And we are live. Welcome back, everyone, and thank you so much for joining us again. My name, as you guys know, is Austin Hankwitz, and I have a very special guest today who has an incredible background both in investing from a fundamental and technical analysis perspective, which is why she's joining us today, Katie. I'll let Katie introduce herself, but long story short, to just give you guys a quick agenda, we're going to be talking about technical analysis, the tools Katie uses to try and decipher if she thinks a stock is really hot, if it maybe is kind of on the cooler side. We're going to be talking about all that fun stuff today. But Katie, hop in here and introduce yourself.
Thanks, Austin. I'm glad to be with your audience here today. My name is Katie Stockton, and I have a company called Fairlead Strategies. We produce technical research that is research based on price alone. So that's what really differentiates it from what you're doing over there on the fundamental side. We analyze public equities primarily, and we're doing that using the charts and technical indicators. And we publish research for institutions, individuals, anybody who has an interest in the markets really can leverage these tools to their success. So it's the best part I would say about the charts is really the risk management element of them, that you can get a sense of what the risk reward is for any given position that you're considering. And right there, you have such value add from the process of evaluating these technical tools that I'll introduce today. And also just finding opportunities. We're always on the lookout for the next big thing, aren't we? And
Absolutely.
I think the charts can help us get closer to that. And, it does take a little legwork, but that's what we're trying to do in our work. We call it alpha generation, looking for things that might be uncovered and have good upside potential. My background, sorry to interrupt. My background, I've been doing this for about 25 years, and I started actually in college. So in college, we had some coursework, believe it or not, in technical analysis. That was just sort of fortunate because I think at the time there were only 12 universities that had technical coursework. And so we studied investments, of course, alongside that. And so I was introduced very young to technical research. Of course, now it's so much more accessible than it was when I was in college. But that inspired me to pursue it as a career. And I started my career working for a large asset manager, doing charts solely for them and helping them manage their portfolio. And over the course of my career, I've spent most of my time on Wall Street publishing as a sell-side research analyst, so basically a technical strategist, but doing a lot of my version of bottom-up work, which of course is very different from yours.
Totally. Wow. Thank you so much for all the added color. I didn't even know all that. That's incredible. So let's start off with talking through the different tools you use as a technical analyst. I know a lot of people here might say, all right, Austin, how on earth, and I'm one of those people, right? How on earth are we going to predict where a stock's price might go by just looking at the price itself? Shouldn't we be looking at the management team or the company's products or the profit margins or the potential growth, right? Because those are the sort of things that we can really conceptualize and sort of wrap our heads around. Looking into just the price is a little bit tougher. So with that being said, I know there's several tools you use to help aid you in this process. And one of them, I'm not sure if maybe this is a tool, maybe it's not, but I think this is something people can begin to wrap their head around. And I'm not sure. It's something I read online a while ago, but it's volume. I think technical analysts use volume sometimes. And if you guys that are watching might not know what that means, volume is the number of shares that are traded on any given day, right? So if I've got, call it 500 shares myself, and I trade it to someone else, that's 500 shares in volume. And so when volume goes up, that can be an indicator of something. I'm sure Katie will tell us. And maybe when volume goes down, is on a trending down slope, that might be an indicator for something else. But I think, that's a very easy sort of way, I guess let's call it a baby step even, to wrap our head around what technical analysis might begin to be. So Katie, talk to us maybe how volume might play a part in your price analysis, kind of the whole picture of pulling together what the price of a stock might do in the future.
Yeah, so let me start on your first point as it pertains to understanding the companies, because that's incredibly important, right? Think of it as a complementary discipline. So technical analysis, fundamental analysis, because the company is what drives the trend. And then think of the charts as a way to analyze the trend. I would not ever invest without looking at a chart. You generally want to buy something that's been going up and you want to sell something that's going down. The reason it's going down, the chart will not answer. The reason it's going up, the chart will not answer. But it will tell you that it's either outperforming or underperforming. And you have to believe that there's probably a good fundamental reason that that's happening, or even perhaps more of a macro influence, something sector related, or just, sort of an international influence, something like that. So you have to trust in the charts to some degree to reflect exactly what you're looking at with the balance sheet and the product offerings and the management team. All of that matters a whole lot. So think of the charts more as a way to answer what, not why. And the what part is going to help you with market timing. Market timing is very important in understanding that risk reward. So rather than trying to be super predictive when we're looking at price charts, I'm not going to say the S&P 500 index is going to be at this level at year end, because honestly, I have no idea where it's going to be at year end. Even now with year end so close, that would just be guessing. But to be more understanding of the price momentum as one force, that can be incredibly useful. And also relative strength forces, meaning, is this security doing better or worse than its peer or the broader market? Do I want to look at Home Depot or Lowe's? Both good companies, both I can make a compelling case for, but what stock is doing better? So it's going to answer those what questions for you. In terms of the volume piece of it, the volume, there's only two data points that the market lends to you. So it's price and volume. I, unfortunately, am not the right person to ask about volume because I don't use it as a big piece of my sort of methodology or process. Now, if you read the textbooks, it will certainly say volume holds importance. You want to see volume growing into uptrends and decreasing into downtrends if you're bullish. That's not often the case anymore, unfortunately. So as you know, with the markets having evolved over the years and technology too, we have so many more investable products, meaning exchange traded funds and derivative products like options. And these things all have an influence on market volumes. And that influence, you could almost argue that it's not like real volume. So in that sense, it's something that we might not want to spend as much time as we used to, at least measuring, because it might not have almost what you're trying to get away from it, which is that kind of supply demand element. We do want to be buying something that has good demand and vice versa. But I think you're really going to get more of that takeaway from price as opposed to volume in these days that are so swayed by these ETFs and other products.
That makes a lot of sense, and I actually didn't even think about that. Wow, that's incredible. So this to me is really eye-opening because you mentioned you're more timing the market. You've mentioned a lot of other different things in relation to entering a position and exiting a position. I think it's funny too. I'm not sure how many of you guys watching this have read my Zero to Hero kind of like ebook that I made. That's like 50 some pages long. But one of the best ways that before I even look at any stock, I always look at the chart, right? I feel like there's other people out there that know more than me. And if for the last couple of years, the chart's generally trading up and to the right, that means the company is generally doing something correct, right? Or if it's trading down and to the right, then maybe they're not doing too hot. Like I feel like that is obviously, a very big thing to look at. And so let's kind of give me the play-by-play of, hey, we think that this company it might be a good idea. We know that, we've looked into it from a fundamental perspective. It makes sense. Now let's begin to look at it from a technical perspective. Give me the play-by-play of sort of what those steps look like, what you look at maybe first, maybe how you, what that decision process looks like, and maybe even if you want to share your screen to maybe share some of this in real time, we'd love to see it.
Of course, yeah, I'd be happy to. And let me just give you a quick overview of my process, but I want to sort of add to that it's not at all comprehensive as it pertains to the discipline of technical analysis. So I'll share with you some of the tools I use, but there are so many tools out there. So my hope is that your viewers will be encouraged to do more research, right? With the things that I show them, I think they're compelling and they're my methodology. And I think just the most important thing is that you come back to the same tools. So once you find the time frame that suits you the best, the indicators that suit you the best. Stick to those and don't try to, constantly reinvent the wheel, because that's where you start to get your biases kind of built into what you're looking at. Confirmation bias, we all know about that. And so if you stick to a discipline, the indicators will help set you on the right path. If you think about a technical indicator as like a mathematical gauge derived from price, and it's often binary. It's designed to give you like a buy signal or a sell signal. And there's no arguing with that, right? So either you have this so-called crossover or other indication that this is a buy or a sell signal, and it is what it is. Now, your decision can be whether you ignore it or not, right? But those technical indicators often provide a much less gray area. They give you a black and white answer as to what the chart is telling you. So that's where I find real value in the indicators. So while some technicians might just use price and a moving average as an example of one tool, I tend to use a lot of technical indicators because I find value in that more sort of clean and clear-cut input, whether it's a buy or a sell. And then, but I'd say before that, when I look at a price chart, I usually use bar charts. There's a lot of different varieties of charts. Candlestick charts are one that are very good visually visual representations of different trading days. We also have point and figure charts, which look like a lot of X's and O's. So that's a whole learning curve there, but they're incredibly valuable. But we tend to gravitate towards bar charts, which show a security's open, high, low, and close represented on a chart. We take that bar chart and we look at it over multiple time frames. So we're looking at a daily bar chart. So each bar represents one day, a weekly bar chart, and a monthly bar chart, all next to each other. And that gives us what we feel are short, intermediate, and long-term takeaways. And to have all of those on your side, that's the best case scenario, but it's not always the case, of course. So we usually want to have the long-term trend on our side, the intermediate-term trend, and the short-term trend. But maybe we'd be willing to take an opportunistic position that doesn't have all of those timeframes supporting your bias. When I look at these bar charts, I'm looking for primarily potential areas of support or resistance. Support is a potential area of buying pressure, meaning where there might be some pent-up demand at a price level, and vice versa, selling pressure near a resistance level, a place where a security might naturally bump its head. And there's a lot of ways to analyze this. And this is where I think it really is the best place to start is honestly just dedicating some of your screen, and I'll share mine, to a chart. And the more you look at the charts on your own screen, the more comfortable I think you'll get with this concept of support and resistance. Bear with me here as I hope this pulls up. Okay, so you see Xilinx, I'm hoping.
Yes,
That's
yes.
one great example of a stock that's accelerated and nearly parabolic move, right? So with
I think
this chart,
this is a semiconductor company, right? Or a chip
that's
company.
right. That's
Okay.
right. And they've really gained some relative strength versus the broader market recently, exhibiting some upside leadership. And you can see this great, rally, corrective phase, and nice follow through here. There's a lot of indicators on here that we probably won't have time to get to today. But very importantly, let me show you one concept of this support and resistance. Xilinx had met sellers around this peak, which was about 154, and that was towards the end of 2020. And of course, just recently, we saw it get through that level. So this is your resistance, and this becomes a breakout. We spend a lot of time looking for breakouts and also breakdowns to try to understand, if something has cleared itself of an important level or an important hurdle, and that can hold some information. You saw, of course, what happened with Xilinx's breakout. Here, too, you see a shaded model. This is called the cloud model, somewhat appropriately. And it's another way to understand where there might be some support or resistance on the chart. You can see the corrective phase came right into the upper boundary, that shaded area, held, and then resumed higher. So that would would be a great way to understand where maybe downside would be contained from a longer term perspective. Even in 2020, you saw a breakout above the upper boundary of the cloud that was somewhat actionable in terms of an intermediate term takeaway on this weekly bar chart. So we are always looking for these levels. Peaks and troughs, so former areas of selling and buying, are great ways to understand where it might happen again. Moving averages, you can see a lot of moving averages here. These are the green and purple lines representing the 10 and 40-week moving averages as an example. Those can also be gauges of potential buying pressure and selling pressure. You probably heard of a stock coming into its 200-day moving average and meeting support. Probably the best example that we have of late would be Facebook, having come down with its corrective phase and discovering support near its rising 200-day moving average. You see, I'm hoping you see, here this purple line is great, tested successfully earlier this year and then again recently. So that purple line is basically a reflection of that 200-day moving average. So sometimes that's the case as well when you see the buyer step in at these important moving averages. Listen, why that happens, I think it's in part because it's somewhat self-fulfilling. There's a lot of eyes on these levels and a lot of people saying, I'd like to really add exposure to Facebook when it gets back there because they feel like it's a mean reverting thing. Or also there's a lot of algorithmic trading systems that have these levels that are very easy to program, sort of keyed into their system. So that's why you often see a flurry of activity around these moving averages. But you can see there's a number of ways to understand where stocks may peak or trough around these important levels. Some get a little bit more mathematical, as an example with Facebook, just because we have it pulled up. We'll draw something called a Fibonacci retracement level. So this is derived from a mathematical sequence called the Fibonacci sequence. And you can see one of the ratios, which is this here, provided some support as it corrected. So there's a lot of creative ways we can do this. It's really where the fun is, I think, in analyzing the charts, where you can just really play around with the visual elements that you see on your screen without getting too caught up in the nuances of indicators and what have you. But it's a great place to start. It's where we start with our analysis. And then we consult the technical indicators to then say, okay, well, we have this breakout. Is it really actionable? How much upside might we have from here?
Very interesting, Katie. So if you don't mind flipping back to the first chart we were looking at, I think a question, and sort of you alluded to this, right? It seems like, this was a breakout. Okay, so we have a breakout. What do we do now? What are we looking at now that the stock is going parabolic, right? A lot of companies right now, their stocks have gone pretty parabolic over the last, call it, year or so. What do the charts, what tools can we leverage to help us figure out maybe when to sell, when to take some money off the table, or when to continue dollar cost averaging?
Mm-hmm. And, you bring up sort of a point in your question, in that the charts are really often used for sell discipline alone, because I think that's what we struggle with. It's somewhat easy to find great companies, right, that you're excited about, but sometimes you succeed in your position and you just don't have a sell discipline, and sometimes you'll ride it lower and be kicking yourself. So I think the charts can help us get to a point where we can be a little bit more systematic in the way that we're approaching our positions. As an example with Xilinx, and I don't know if this is going to work out perfectly, but we'll try. We have something called a measured move projection, and I'm going to draw it on the chart right here. So you see, here was the prevailing uptrend in 2020. We're often going back to the COVID low in 2020 to start our analysis, because it was the start of this current sort of bull market cycle. The corrective phase, we take the low point of that corrective phase and project the original trend higher from that. And that's called a measured move. And it would be a 100% projection of the trend, or uptrend in this case, that preceded the corrective phase. And that creates a price target. So it said Xilinx at the breakout point could reach 200. At the time, it probably seemed a little bit crazy, but here we are. So, of course, it was very surmountable. And that tells you that, well, perhaps a lot of the upside is already in the stock at this point. It's already made that measured move, which means it's already upheld the prevailing trend drawn back to the COVID low. Maybe there's a position that has more upside now that this has reached its targeted level. Another way to understand a targeted level would be by taking the next resistance. But in this tape, we have so many stocks that are at new all-time highs, and that means they have no resistance left on their chart. So we have to use other means like this measured move to try to understand upside. One other way that I'd cite would be to consult round numbers, because how many people said, okay, well, I want to sell Tesla at 1,300. It just is a psychological force from the market participants to have that number in mind. And that sometimes becomes a resistance level by the nature of it just simply being a round number. So we have ways of deriving price targets. But on top of that, we then use those indicators that I keep referring to. If you think about technical indicators, I like to classify them three ways. This isn't necessarily something the next technician would confirm or not, but the first one would be trend following, which I also would say is synonymous with momentum. Overbought, oversold readings. So you're trying to understand if something's stretched on the upside or the downside. And then also relative strength readings, which usually is taking like one security relative to another or relative to a benchmark and understanding the trends there in relative terms. Now, we use primarily for those exits, the sell discipline, overbought, oversold measures combined with momentum. So the overbought, oversold measures, you actually see one here on the Xilinx chart. This is called the stochastic oscillator. The probably more popular version of this would be an RSI. These are overbought, oversold measures. They're oscillating between 0 and 100%. They're derived from price alone. It's a somewhat complex formula, but what it's trying to understand is if something's getting overdone or overextended in terms of the trend. So when it's above 80%, you have an overbought reading in my stochastics. And that, of course, has affected Xilinx for more than a few weeks now. So the combination with momentum is when you see those stochastics fall back below 80%, well, then I see that as a sell signal. So we don't have that sell signal on Xilinx yet in terms of an overbought downturn, but it is overbought. It has met its target. So then it becomes a judgment call as to whether it might be the right time to rotate into something that has a fresher breakout.
I'm just soaking this all in. This is so cool. This is so cool. I mean, this is actually leveraging mathematics and different types of tools to understand, hey, my price. So whenever I make a price target, it's from like a valuation multiple on revenue or EBITDA in relation to a peer, right? It's, the microchip company that have similar margins and things like the growth and things of that nature comparing to other people. And so that's where I derive my price targets. But this is more saying, hey guys, if it did it in the past at this magnitude, there's a chance it could do it again. And here are sort of the different types of, I guess, just general numbers around what that would look like if it did do it again. And then also, you mentioned this relative strength index sort of alluding to, hey, it's done it now. If it gets below, if the strength of this run up begins to kind of dwindle and sputter, maybe it's time to take some profits off the table and move into another opportunity elsewhere.
Yeah, I think it's great in terms of starts to sputter, because that's basically your loss of momentum. And we have a tool called the MACD indicator, very, very popular technical tool. It stands for moving average convergence divergence method. Sounds fancy, but it's really based on moving averages of price. And the design is to actually identify when it is starting to sputter and when that sputter is more than just noise. So if you think about a moving average, it sort of smooths out the price action to some degree, and you'll see it roll after price actually peaks. But we welcome that lag in a way because we want to make sure that we're not getting too caught up in the noise. And if you do get caught up in the noise, sometimes you can miss really good moves. Like if you were exposed to Bitcoin as an example, I'll pull up the chart here. And you said, well, gosh, I see a loss of short-term momentum. Is that something that we should sort of reposition through or not? Well, then if you consult your MACD indicator and it's still pointing higher in the weekly chart, you can trust that perhaps it's just seeing some short-term noise. And that's something that you might just want to hold on to, especially given the difficulties of trading around these cryptocurrencies. So I think that just having those MACDs, a momentum gauge on your side can be really important. And then also being respectful of any overbought downturns that do unfold. I think that's a pretty good winning strategy and somewhat simple, something that you can access access for free online, really just by using any of the online charting platforms, of which there's tons of them that are very high quality these days, that have access to these indicators and tools, and dedicating a little bit of your screen to a chart that shows some indicators. I think it's always beneficial to do some research, to do some reading, but by just simply looking at the charts, I think you'll start to feel how you can use these indicators for at least a sell discipline, but also on the flip side for looking for opportunities, looking for those breakouts, breakdowns, and then also looking for perhaps something that's really oversold and is ready to start moving. So I think they're just great tools to have on your radar.
So a question I have, Katie, and this is going to be my last question. Can the relative strength index be above 100? Is that a thing?
It's not a thin thing.
Not a thing. Okay.
Yeah,
But it can be above 80.
So the RSI, which I don't use, but the stochastic oscillator kind of gets you to the same answer. Both of their formulas don't allow it to oscillate outside of 0 to 100. But necessarily, like if you saw 100% reading, which of course is quite rare, that wouldn't necessarily be a sell. So for the RSI, probably a little bit more so than for the stochastics, but it's that downturn. You always want to wait for the downturn, in my opinion, because that's when you have that loss of momentum that's meaningful. We want to acknowledge, I would say, I think the word overbought and also oversold is somewhat widely used and sometimes misused, in that overbought isn't necessarily a bad thing. Something that has momentum should also be overbought until it loses momentum. So that's really the key, to make sure that you're riding the momentum while a security has it. You ride it either to your fundamental price target or perhaps a technically derived target, and that's your comfort level. And then you either reduce near that target, or you simply wait for that downtick in momentum that you're uncomfortable with. Some folks also like to use like a stop loss discipline. And for that, you can also use some of these concepts. For one, it would be support. If you took maybe the 50-day moving average and said, well, I'm just going to put my stop loss right below the 50-day moving average because I'd be uncomfortable either in percentage terms or otherwise with a move of that magnitude. So there's a lot of ways you can combine these tools to arrive at a really, I guess, systematic approach to the markets.
I am absolutely mind blown and now so curious. This is so cool.
Good.
Very interesting, Katie. Very interesting. Well, we are now at almost 30 minutes. So if these people haven't learned something over the last 30 minutes, I'd be very surprised. So what I'm going to do is I'm going to take this as they're watching this. This should be on YouTube by now. It'll be on YouTube. Share it with Substack. Share it obviously with your community if you feel necessary. But if the people of my community, if you guys want to learn more about this or think this is something that maybe we should host Katie on a monthly basis or a bi-weekly basis where we sort of dive deeper into maybe your stock ideas or maybe mine, and then we just kind of have a nice little back and forth, and we can kind of bring some more technical clarity to what these companies' prices could be doing in the future. Definitely let me know. We're gonna work toward that if that's something that we all agree on, and we'll have some fun with it.
Sounds great, Austin. Thanks for the time today.
Yeah, no problem. Thanks, Katie. Talk to everyone later.
Take care.